Let's bring in China Beige book CEO Leland Miller. Leland, great to have you with us. Too early in what sense?
Well, I think the too early is about giving up on the Chinese recovery. You know, traders had it wrong from the beginning on this. There was a lot of excitement back when the COVID zero band-aid was pulled off in November and December. And there was this idea, oh, well, the economy's reopening. Yes, the economy's reopening, but it was not about to reactivate. And so December and January and February, these were months that were never going to show recovery. People were getting sick. Hundreds of millions of people are getting sick. You know, the COVID zero structures are being broken down. So the idea was always, look, Q1 is going to be rough. As we start getting to March, probably April, then we're going to start seeing the potential for a real economic recovery. I'll say that we just got our May data in. Our May data are much better than anything that we had been seeing with the government's reporting for April. So we're seeing some of the green shoots of this recovery, and it's something worth watching, not yet giving up on.
There's also the misconception that it would be the consumer driving the recovery, and China's never been a consumer-led economy. It's been a manufacturing-led economy, Leland. So I think that's part of, you know, sort of the idea that it should have been a faster bounce back. But I do want to talk about the CEOs in China and whether or not that relationship can be repaired. Is it possible to have the two capitals, you know, have tensions, but at the same time have the U.S. CEOs wanting to do business in China?
Well, it's possible, and it's certainly been what we've seen in the past, but it's getting tougher and tougher. I mean, the reason that Jamie's over there, the reason that Elon's over there is that they see an opening right now during what China's announced is, you know, the year of welcoming foreign investment in China, 2023. It's supposed to be a big year for that. At the same time, China has launched its large crackdowns of foreign businesses. You know, they're regulating data flows outside the country. They are not being very hospitable to foreign investment or to foreign businesses. So there's this natural tension that as the U.S.-China relationship deteriorates, you know, what do we do? How much do we push back? You know, what signals do we send? And right now, it's a very confusing situation for CEOs. They're trying to do all they can to try to patch up the sinking ship. But, you know, it's tough right now.
Leland, so you pointed out that in your note that you think the party's crackdown on foreign firms in China is, quote unquote, risk level rising. And you've pointed out that you think the economic risks are really the opposite, or that if anything, I hear what you're saying. I agree with that. In fact, I think if we think about a world where China growth in the mid 5% and 5.6, 5.7 is the upside compared to where we were 10 years ago, this would have been a disaster. This is actually very bullish right now, and I think that's bullish. But how about China's crackdown on their own firms? Like, that to me is the biggest part of this. And I look at, whether it's the K-Web, I look at the FXI, which has underperformed the S&P by 72% in the last decade. It's China's treatment of their own companies and corporate governance and those macro risks that I think are a lot more important than the economy.
I agree. These are, this is what people are looking at. They're looking for signals from the government. Does the government want to do business? Is the government looking for growth? Is the government looking to incentivize innovation in its economy? And you look at what's happened for years now with the big tech firms. Yeah, you look across the economy and you see a lot of worrying signs that what Xi Jinping's economy is doing is sort of battening down the hatches. Maybe not for kinetic conflict, but for economic conflict for sure. So, look, there's a lot of mixed signals being sent. The rule in 2023 should be we are going to see a better bounce back. It's too early right now. Q2 numbers can still beat estimates for the Q2 GDP print. But also, it is the longer backdrop here is a structural slowdown. So when you're investing in China right now, you have to think, do I catch the cyclical bounce back in 2023? Do I acknowledge the long-term structural slowdown that's going to be the norm going forward? How do I evaluate political risk? How do I evaluate this real geopolitical risk that's ramping up? It's a lot harder to do business in China right now than it's ever been.